Welcome, everybody, to the Chinchilla Pickin' Podcast. It is April the 16th, 2022. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I'm here with Brandon Beaver. Brandon, how are you?
I just did a couple of overnights at my job, and my hours are all screwy. And, I just feel weird. I don't know what day it is. I don't know what time of day it is, but I feel just jet lagged. You did third shift for like years. I don't know how you did it.
I had to, given the custody situation and me wanting to spend time with my daughter. I just had to make it work. But yes, tiredness, you never feel right. You never feel fully awake. It affects your weight. There's so many bad effects, negative effects because of it. And doing it for years just messed with my body, and it was awful. But the reason why I did it was worth it. If you don't have to do it for that reason, then I don't recommend doing it at all.
Well, I only did it for 2 days, and I feel like a wreck.
Right. And you never see the sun because you're working all night and you're too tired in the day to go out. Yeah. So you just never you never see the sun. And so you don't get that vitamin D and that refreshing feel. And it really affects you. It really does. Like you said, I did it for years, and it's just wouldn't recommend it to anybody. But exciting week, a very exciting week. I was just out in California earlier this week at a great summit. It was the ACES Summit, American Indians in basically like STEM, science, math, engineering. If you don't know, I do have Native American, part of a tribe, and that descendancy there. And it was a good opportunity to be around other natives and talk about that and get out and meet. And, there's a lot of them out there that are in good positions in around the companies in the world. So it was a good opportunity and I enjoyed it. But back here again, and now I get to go leave again, going down to Savannah, Georgia next week. And that's going to be fun. So I'm looking forward to that. Tybee Islands where we'll be staying. But so if you guys see me out there and you want to say hi and you're a listener, just come up and say hi. I'll talk to you about stocks forever. It'll be a good time. My daughter will love it. No, she won't, but I'm just saying that. We have a good show for you this week because there was a lot that happened in the news this week. I promise you crypto. So Brandon has very willingly allowed me to start off first with that once we get going, and I'll get into crypto and all that stuff that I promised I would talk about. He's got a few things he wants to mention. Definitely going to have some calls, I think, for me at least, just because the market took a downturn and there's some stronger, like I always say, when the whole market takes a downturn, there's some companies that don't deserve to go down with the ship, that they're going to bounce back up. Those are the ones I'm saying buy right now. So I'll probably make a few calls later on in the show about that. But Brandon, if you're okay with it, let's get going, right? You okay?
Sure. Yeah. I've got a couple of topics myself. First will be that you're wrong. I don't know what you're going to say yet, but you're wrong.
Right? Just it's crypto, so I'm wrong. I mean, that's all we need to know, listeners, and that's the show. Have a good night. Rules, guys. Brandon and I get together 5 minutes before the show and we tell each other what we're going to talk about. You hear the live discussion here on the show. We hope you enjoy it, and if you do enjoy it, please hit that subscribe button to subscribe on what other streaming service you're using to listen to us. We appreciate the follow and the subscribe.
Hit the subscribe button, Mom. Gosh.
She's the only one who's not hitting it. Can you please ask her?
She's the only one listening.
You're right. Sorry about the lack of content past week. We're going to work better on that. We have a good plan and we're trying to work on that. There was just a lot of things going on. Let's get to it, man. Crypto. Brandon, I know you have a not a negative, but like a sour taste in your mouth when it comes to cryptocurrencies, and you're skeptical, right? You're cautiously skeptical. And like a lot of people are, right? A lot of people are, and a lot of people are don't really understand it, and that's what makes them not want to get involved, right?
I don't know that I have a sour taste in my mouth. I've traded Bitcoin a couple of times. I traded Doji when that whole thing was going crazy because everybody was trading it, and it was I don't want to say easy to trade, but it was easy to trade. It was, but when you get a 30% gain pretty quickly, you got to take it, right?
Right.
But it can be very hard when you get in your own mind sometimes, especially if you're a new trader, especially if you're doing something that you have never done before, like trade doji, and you get a huge 30% gain. You're like, oh my gosh, yeah, is it going to go higher? Should I take it now? Should I take it now? Should I take it now? That stuff like that. So which is why you really have to have a good strategy and follow that strategy to a T and not let your emotions get in the way. But anyways, I'm just kind of in a wait and see moment right now with crypto. With inflation on the rise, I want to see what Bitcoin does.
Gotcha.
We're in the midst of an inflationary environment right now. And one of my theses was that Bitcoin was built to beat inflation. And I just want to see what happens.
And I sort of agreed, but disagreed with you on that point last week where, I don't believe it was. I mean, yes, at the end of it, after we talked through it, I guess I kind of agree, but like, that's not the purpose for buying it, is to beat inflation. The purpose for buying it was to have your money in a currency that is not controlled by a government.
Yeah.
And
well, let me say this real quick. So if there were some people out there that was saying that Bitcoin would beat the US dollar and all that, and of course right now we're looking at Bitcoin. It's down 36% for the year while we have rampant inflation going on. However, for the past 5 years, it's up 3,241%. And so if you look at that, did people front load into this? But did this predict inflation?
it may have predicted inflation, but I think it may have predicted more of a mistrust in government for that aspect. I mean, and right now it's still beating US dollar. It takes 40,000 US dollars to buy one Bitcoin. So I would say that's a definite beat in my definition of beat in one currency, beat in another currency.
Yeah. So, I mean, like, as you said, there's many reasons to buy cryptocurrency. What I was just talking about is just one of the many reasons to buy crypto, or one of the many reasons people have to buy it. But my question is, will the trend that it's in the past year, 36% is what it's down by, will that reverse? And I
want to sort of answer that, but I also want to talk about, like, there's a yes and no to this. Yes, cryptocurrencies will bounce back up. Will it be Bitcoin? I have some investment in Bitcoin. I believe Bitcoin's going to continue to move higher because that's the mainstay, right? But there's so many cryptocurrencies out there. It's like with any new market. Remember the .com bubble? I don't know if you remember. Some people might not remember. But when the internet first came up, everybody just kind of said mouse.com and cars.com and house.com and pins.com. And, most of those websites are no longer in existence for a reason. There was a million different websites that popped up and they're no longer around. And so that's what a lot of people feel is going to happen with all these cryptocurrencies. So my point is, like, what is the future of the cryptocurrencies and what can be a sustainable way to do it? Let me talk about some of the different ones that are out there and kind of like how they're being used, right? So there's Ethereum, right? Ethereum, and that's one a lot of businesses are using to secure their technologies, using that blockchain technology with Ethereum behind it. And so it's being used in that aspect. That's why it's gone up in value, because major companies are utilizing it in that way, right? Bitcoin's being used just as a buy and sell, purchase. It's not being used to secure systems. And so there's different uses for different cryptocurrencies. Now you have to own some Ethereum in order to make that work. And in that same thought process, let me talk about a new one that's come out and how it's being currently used. There's one called Polkadot, right? A lot of people are talking about Polkadot. This was actually brought up to me by a friend of mine. She texted, I believe you and I both, in a text about, hey, do you know anything about Polkadot? And at that time, I was like, no, it's just another cryptocurrency, right?
Yeah.
And she had heard about it. She asked me about it, and I didn't know at that time. So I did some research and I looked into this and I looked into some more. And then when I opened my crypto.com account, which I'm going to get into if I'm going to keep that or not keep that here in a few minutes, Polkadot was one of the ones on there. And Polkadot was one of the ones that crypto.com was going to give me a percentage return on if I allowed crypto.com to use Polkadot. So they call that crypto staking. When you allow a company or a blockchain to use a particular coin and they give you coins back in return, it's called staking, crypto staking. Now, what are they typically using those coins for that you're giving them? So let's take Polkadot, right? I want to use that one as the main example here today. Polkadot is I give the system 10 Polkadots, they use that to verify other Polkadots and other exchanges and use it as both to verify exchanges from one person to another and to secure systems. So Polkadot's being used for that. And every time I allow them to use that, the system, the AI that's been generated and let loose will automatically give me rewards in Polkadot for allowing it to be used. Do you understand? And so that's why Polkadot staking right now is very, very, you get favorable returns. Right now, they're looking at you can find around 20% APY returns on your Polkadot staking, which is a great return for a year that beats the S&P. And you could just be staking Polkadot year round. Now, the problem is Polkadot, unlike the last time I talked about staking, I talked about using the USDC coin because it doesn't move, right? It's stable, $1 for one coin. Polkadot is a cryptocurrency, so it's going to move. So what you're hoping is that it will always move higher because people are getting these high rewards for staking. You're expecting more people to own it and keep it and hold it. And then you're expecting more companies to use it because there's a lot of users out there allowing you to stake the Polkadot. So the thought process was for continued growth in that cryptocurrency, in that coin. So I bring this up to show you how some coins have a brighter future than others because there's an actual use for it. And then others, such as Doge, have no actual use. It's meant to be just a currency, but why would you use that currency when I could use Polkadot or Ethereum that actually has a use and people are going to continue to use it? You know, thoughts real quick on all the information I just threw out at you.
So here's my strategy. All right. I'm going to go around and ask all of my friends, okay, which one's buying GameStop for the long term? Okay, and then whatever cryptocurrencies they're in, I'm going to stay away from, and then I'll be golden. So all three of my friends,
right?
Dave, my girlfriend, and my mom.
I am not buying GameStop.
So are you long GameStop? Okay, what cryptocurrencies do you have? And then I'll just not buy those. Now, I don't.
But I mean, do you understand what I'm saying and how I explained it? Was it kind of clear?
Yeah. Does Polkadot trade on what's the major crypto wallet?
Coinbase, crypto.com, Binance. Yes, it trades on all the big ones.
Not on Robinhood, but
no, not on Robinhood.
Okay.
And on Robinhood, you actually don't have a wallet. On Robinhood owns the coin. So on a lot of these, like crypto.com, if you don't have a wallet that you use and you just use the crypto.com's site, then you actually don't own the coin. You're just trading the coins that crypto.com owns.
Doesn't Robinhood, aren't they coming out with a wallet? Weren't they?
They are, yes. So yeah, they're coming out with a wallet. Most sites like Coinbase, Crypto, Binance allow you to use a wallet if you have one. But if you don't have one, they'll be more than happy for you just to buy and sell the coins they own. And they make a percentage off of it. And it's free money for them, basically. But you have the choices with the other ones. You don't have that choice with Robinhood.
Gotcha.
But I mean, I just want to make sure people understand that, like, when you're looking at a cryptocurrency, look to find one that has a use. Look to find one that, actually serves a purpose, right? Yes. Now, Bitcoin is more of just a currency used to buy and sell, but it's so big and popular and it's everywhere and it's accepted at so many different places that I still believe in the future of Bitcoin because of that, because it has grown to arenas and football games and Ticketmaster and so on and so forth, because you could use it at all these venues and sites. I mean, it's going to be something that will continue to be used going forward in the future.
I wonder if the price of these if it's going to continue. It's weird because it looks like Bitcoin and crypto, it's followed tech.
Yeah.
in the stock market. They've traded together, and I wonder if it's because it's the kind of trader, which is a lot of speculation. Which that's not necessarily a dirty word. When I say speculation, I'm not being insulted when I say that. That we all speculate a little bit, but the speculative stocks have kind of gone up and down with Bitcoin at the same time. With interest rates on the rise, I wonder if that'll continue to happen and if there's a little bit more downside for Bitcoin or if we're starting to reach bottom. Also, I wonder if you're long on Bitcoin, does it even really matter?
If
So
you're
can you
yeah.
buy here and then, wait and you put your emotions aside and hang on to it, and will you be fine in 10 years?
I firmly believe with that last part there that long-term investment, you buy here. If you aren't already in, buy here and just hold. Even if it does go lower, I continue to bring up the Facebook example that we had here on the show. Maybe just put 30% of what you want to put in now, and then if you think it's going lower, put another third, and so on and so forth.
Yeah.
Buy on the way down and build that position. That is definitely one tactic you could use here. Now, I don't see a future for a lot of these coins. I really don't. Cryptocurrency is oversaturated as a whole.
Anytime you have a new market of anything, most of what comes out of it doesn't exist in 10 to 20 years.
Yep.
Even if it's the most useful innovation, whether it's railroads going back all the way to the 1800s, the steam powered locomotives, most of those companies didn't exist in 10 to 15 years, and it was a very highly speculative environment for the railroads at the time too. And a lot of people lost money, a lot of people made money, but it's something that you have to watch. The airlines were the same way when commercial air traffic was invented. Most of the airlines that came out then didn't exist in 5 to 10 years. Websites and e-commerce, most of what existed during the dot-com boom no longer exists now, and what does exist now is oftentimes valued at a loss or a lot less than what it was then. So you just have to be careful, and you have to pick your winners. And it's not that it doesn't belong in your portfolio. Speculation does belong in your portfolio. You just have to put it where it needs to be as far as a percentage goes, and understand your own risk tolerance.
There you go. I like the explanation because it applies to all things. I mean, you're not a crypto expert by any means, but that same broad principle does apply to the cryptocurrency market as it does to other fields and sectors. Yep. So, you follow your principles, you will be successful. The last thing I want to end with on this whole crypto section here of this podcast is crypto.com. I want to talk a little bit about this for next couple of minutes. I opened the account. I threw a few $100 in. I did the $250 for the 90-day stake in or what have you with the USDC coin. I'm getting my returns, right? It's not much money. It's like 50 cents a week off that, and I get a free Crow coin every so often from doing little fun activities on the app. And that, that's cool. That's like 45 cents, 50 cents extra or two. So you can accrue money. Yes. And you can buy and sell crypto, but it's a high percentage fee. It's like a 3% fee for crypto.com's site. So I'm not a fan of the 3% fee, but other than and it's very hard to figure out how to get your money out. I just want to say crypto.com, if you're listening, I know you listen to our show, right? You did not make that easy or intuitive at all to figure out how to get your money out of there. So I mean, there's definitely in my final review of this, it just seems like it's more cons than pros. I would stick with Coinbase or Binance over crypto.com right now. However, I see they have a big future, crypto.com, because of where they're headed. They're headed to credit cards, banking. They're headed into trading stocks on the website as well. So they're headed in a more broader view of the whole financial markets and world where they're going. So they might get better as they open up different avenues of income and income streams for the company.
Okay.
Yeah, but right now, it's just too much of everything's a hassle on it. At first, I was like, this is great. It's awesome. Now I'm like, no, this is a hassle. It's just been a hassle for me lately. And, like I said, they are honest. I signed up for that 10% APY on USDC, and they're giving me that return. So I'm getting that return on it. But with only $250, I'm only getting like I said, 50 cents a week. So it's not really, I'm not raking it in, ready to retire off that. So that's all I got on cryptocurrencies. I know that was a good 20 minutes. That went by fast on just cryptocurrencies.
Are you a buyer of Coinbase right now?
Of Coinbase right now?
Yeah.
No. Coinbase moves with Bitcoin, and if you expect Bitcoin to keep going down, Coinbase will keep going down. It moves directly with Bitcoin.
Okay. What about
they're linked? They shouldn't be, but they are linked because Coinbase makes its money off of fees. Yeah. And and if you don't have a wallet, you're basically using Coinbase's coins. You're buying a say Doge. I buy a Doge coin, right?
Yeah.
But I'm buying it from Coinbase. I don't really own it, and then I sell it back to Coinbase, and then they charge a fee on it. They're just printing money in that regard, and it's good for Coinbase, bad for everyone else.
Gotcha. What about Riot? I know you've mentioned on the show Riot a few times, but you've talked about trading it, not owning it.
Yes. I do not recommend Riot for an investment. I recommend Riot for a trade. So if you are following Bitcoin and you expect Bitcoin to start moving back up, that's when you buy Riot because it moves with Bitcoin, but it moves in a higher percentage return than Bitcoin typically does.
Gotcha.
So if Bitcoin moves 10%, Riot will usually move 15%. You can make more money quicker.
Okay.
It's a trade, right? It's always a trade, just a trade, but it's a fun one to trade for me. I enjoy it.
Yeah, you've been successful with that. So
I've been successful. So Brandon, I know you said you had a couple things and you told me what they were, but you didn't really go in detail. So I want you to go into some detail on this, but go ahead, take it over.
So I started a book recently, and I don't know how this, like, for the past, like, I've been trading like 15 years and investing, and I don't know how this book escaped me, but it did until recently. And it's What Works on Wall Street by James O'Shaughnessy. And it was written, I believe the first edition was back in 1996. Since then, they've had 4 new editions to update the data and all of that. It's interesting because the data just continues to show kind of the same thing that he originally came up with in 1996, that the patterns kind of stay the same. So what he did is he took the most popular strategies on Wall Street, and when possible, he went all the way back to 1929, back tested them to see what works and what doesn't work. And he also did the same thing with the value ratios that we use, like price to earnings ratio, price to book, price to cash flow, and price to sales, to see which one is the most effective tool to beat the market with. And price to sales is actually what became the most effective valuation tools, and what has worked since 1951 is what he was able to back test to. And I think the end date on this was December 31st, 2003 on the price to sales. So he went from December 31st, 1951 to December 31st, 2003. And just so in case you don't know what a price to sales ratio is, it's calculated by taking a market capitalization of a company, so the market cap, and you divide it by the company's total sales or revenue for the past 12 months. And that's what you get, price to sales. That's how that works. $10,000 invested on December 31st, 1951, and the 50 lowest price to sales ratio stocks grew to $22,012,919 by December 31st, 2003. That was a return of 15.9% a year compounded. The strategy performed well over time. He says, this is a reading directly from the book. The low price to sales ratio stocks beat the market 88% of all rolling 10-year periods. Are you raising your hand?
So I was. So you said that was compounded. So it's 15% compounded. It's not just a straight 15, right? Every year for that whole length. So that's actually, if you're a long-term investor, that's great. Those are awesome returns. I mean, you could literally put $1,000 in there and in 25 years come out with millions.
Yeah.
if you're compounding it. If my math is right, it could be wrong. My math could be wrong. I'm not a mathologist here, but um, yeah, those are great returns. That's a great strategy, and that's going just off using the price to sales, right?
Lowest 50 price to sales ratio stocks in the stock market, and he rebalanced it every year.
So lowest 50, and you have to rebalance it yearly.
Yeah, that's it. Just touch your portfolio once a year, rebalance it, and 15.95% average return.
That's wow. That's incredible.
On the opposite end of this, the worst performing stocks happen to be the 50 stocks with the highest price to sales ratios. So $10,000 invested in December 31st, 1951 was worth just $19,118 at the end of 2003. This is the worst performing set of stocks that he came up with by far. 1984, he said, was particularly gruesome. $10,000 invested in the market grew by more than 50% if you invested it just in the total market to $15,416. But an investment with the 50 stocks with the highest PRs fell by 70%, turning $10,000 into $3,079. So if you would have started it at 1984, then it would have been even worse.
Oh yeah, because it's the 1984. It's a
Yeah.
bad year to start anything, right? Yeah. Inside joke. Sorry.
A central theme of this book is that all strategies that work will have periods in which they don't work. So you just kind of stick with it. You have to be patient, and you have to, just let it work over the long term. On 5 occasions throughout the time period, the 50 lowest price to sales ratio stocks lost 30% or more. In 3 of those situations, the declines came rapidly. But the low PSR strategy beat the market more times than any other value ratio, and did so more consistently. Wow, I'm gonna have to edit that. So even though,
or you can let people hear your mistake and let us know you're human and not a robot machine.
Okay, I'll do that then. So even though 88% of the time this beat the market, there is that 12% of the time that it doesn't. And there's a few times, probably recessions or depressions, the 5 times where it lost 30% or more, but it recovered it, over time. So you have to be patient, you have to be prudent, and you have to stick to your guns and stick with it. That's kind of his key and his central theme throughout the book. You find the strategy that works best for you, you stick to it, even through the bad times. That could be hard for a lot of people to do, even especially market managers. This is one of the points that he makes too. Is one of the reasons why market managers perform poorly compared to the S&P 500 is that they have a lot of customers that lose patience very quickly, and they have a lot of bosses that lose patience very quickly, and that leads to good market managers being fired fairly quickly for sticking to their guns.
Yeah, I mean, it's a sad reality of the market as a whole, because we're not saying what we know works. And I give this example of for us here. I'll use our own personal life examples, and I do this not to boast, but to let people know. I've been trading or investing in NVIDIA for I don't know how many years now, Brandon, since Facebook group, and I was posting on there all the time. And NVIDIA is one. It's like I know that company in and out, and I know when it's undervalued, and I know when to buy, and I know when it's reached a point where I'm kind of like, okay, time to take my profits off the table. And it's because I know that company in and out, and I watch the board of directors, who's coming in, who's leaving. I watch the CEOs and the executives, and I know that in and out. So I stick with the companies I know, and I stick with the sectors like semiconductors and oil and the banks. I understand how these all work, and I trade those regularly, and I stick with them. I don't go out of it. Yes, that's a very generalistic explanation and view of what you're trying to get across, but I believe it's a good example also to give.
So what you're doing when you buy those 50, you're diversifying your performance, as far as like there's going to be some stocks that fail and some that don't. But what's interesting is it doesn't really diversify by sector. So if you did that today, mostly what you're going to get, a large majority of your portfolio would be home builders and financials and insurance. A very large percentage of it, in fact. So I ran a screener based on this test here to see what would come up. And well, before I get into that, let me say this one interesting thing. Usually people say that the small caps are more speculative and they perform worse than large caps, right? The small caps with using the 50 lowest price to sales ratio and the small cap actually perform better over time than the smallest large caps. I thought that was interesting. Both of those groups beat the market over the period, and it gets even better when you combine them. But if you separate the large cap stocks and you're just looking at the small caps, so small caps did better. Go ahead, Dave.
And that doesn't surprise me. And it's because the small caps have much more room for growth.
Yeah.
Right. So if I'm trading, if I would never trade. Well, actually, I have traded Apple. I would invest in Apple, but if I'm trading a big cap company, say Tesla, right? I'm looking for a 2 to 3% return because I think it's going to move that. And it moves pretty much 1 to 2% daily up and down. And if you could day trade that over and over and over again, you're going to make a lot of money. That's how I look at that. I don't look for big returns on the big caps because there's not a lot of room for growth, whereas there usually isn't.
Right.
So there's more room for growth in the small caps because they're either just starting out or they've only been around for 5-7 years. They have a lot more growth to grow into their close. They're still teenagers and not full grown yet.
But in general, if you're investing in small caps, you're going to have a larger percentage of those stocks fail. But it seems to be
for the same reasons I just said too.
Yeah, but it seems to be that using the low price to sales ratio here, which and anybody who says low price to sales ratio, you're usually referring to anything with a price to sales ratio under 1. But we're looking at the bottom 50 as far as the lowest price to sales ratio goes. It seems to be that kind of filters out a lot of the small caps that do fail. So it kind of makes it, it kind of adjusts your risk to a better risk return there. Now like I said, I ran a screener here for value stocks based on the lowest 50 price to sales ratio stocks. What I noticed is that any company that did not have sales showed up on my list as well. So it would just show up as a price to sales ratio of 0. So I wanted those out because that doesn't make any sense to have those. It's just that's an error on TD Ameritrade's part to let them show up as a price to sales ratio of 0. It's because they don't have a price to sales ratio. So what I did to filter those out is I filtered out anything that did not have a price to earnings ratio. So if it didn't have earnings, it didn't show up in my filter. So the 50 lowest price to sales ratio stocks with the true price to sales ratio, and I'll just say some notables that appear on this list. I'm not saying that they're buy or sells or anything. Show favorite Jeffries, which I still think is a buy. So I will say that. I've already traded it. I've gotten out of it already. I might think about getting back into it. But Jeffries showed up. Honda Motor Company showed up. Lincoln National Insurance, Oppenheimer Holdings, and Foot Locker was actually on there as one of the lowest price to sales ratio stocks.
I'm blowing the whistle on Foot Locker there.
I swear.
I'm not touching that. I mean, maybe I'm dead wrong here.
You might.
Based off this, I'm not. But I'm just like I'm not touching that.
It is a low price to sales ratio. I'm not. So when you say buy these 50 lowest, right?
Yeah.
So that
you're
doesn't
diversifying
mean that
among 50. I get
it. Work out. Some of those stocks won't work out. Foot Locker might be one of them. But I was just saying it was interesting that it appeared on that screener there. Another thing that he was talking about, he talks about the strategies that people use other than just the ratio. So the dogs of the Dow is one of the best known and simplest investment strategies around. And this is straight from the book again here. So I'm not, breaking any copyright laws or anything. I'll say it's straight from the book. He says, start with the 30 internationally famous blue chip stocks that make up the Dow Jones Industrial Average, and then sort them by dividend yield from high to low. Once a year, buy the 10 that have the highest dividend yield. hold them 1 year and repeat the process, replacing any that have fallen off the list with the then 10 highest yielding Dow stocks. That's it. He says simple. The simple strategy has been a market slayer since 1929, consistently beating the S&P 500 over all but 2 rolling 10-year periods. So it's got 80%. 80% of the time it's beaten the market. And he even looks at the media. He goes back and says, okay, this strategy wasn't working in like 1992. There's a couple of years of the late 90s when we had the dot-com bubble where it didn't work. And the media quickly turns on any strategy that's not working for any given year. He talks about the Time magazine writing an article that says that the dogs don't hunt anymore because it was just like 1 or 2 years where it didn't work out. And so people lose patience with strategies the minute that they seem that they're not working anymore. But he says, keep in mind, what you have to do is keep a long view here and look at, 10-year, 20-year, 30-year periods and strategies that work for those. 1 year, 2 years shouldn't matter that much to you.
I mean, Brandon, if everybody had the longer view and was willing to, invest in these companies and follow their strategies year in, year out without fail, I mean, you got to have some people who are Carl Icahns and Warren Buffett's and Bill Ackman's. You can't have everybody be in that group. I mean, people do pull out and, oh, it doesn't work for me. It didn't work this past month. Well, I mean, it's worked for you the 12 months before that.
Most of the legendary investors have a strategy and they stick to it even
exactly
the downsides.
Exactly. And just to back that up, guys, for anybody listening, if you have Hulu, there's a thing on Carl Icahn on Hulu that I thought was very well done. And yeah, there were some things I disagree with, but most of it I agreed with. And, go watch it. It's a good watch. It's a documentary. It's Carl Icahn's doing the interview himself. So watch it. It's great. You might get something out of it. You might not. But I hope it reinstalls the point that Brandon's making right now, which is, if you're going to follow these strategies, follow them. You may have a down moment or two, but stick with it. You'll make money.
Yeah. Well, and oftentimes you're buying a beat down stock. The stock is going to get beat down for a little bit longer. You're not going to catch the bottom on it. We've talked about this before in the past. So, if you buy a beat down stock, like I often do, in the coming month, it may be down more. But if you've got a long-term view on it, then just hold it. Don't let your emotions play.
Right. Hey, Brandon, I tell you what, man, you always end up right in the end. So with you, I always feel like when you first get into stock, I'm like, it's going to go down a little bit more at first when Brandon just got in. But you typically are right in the end. I will give you that. Typically,
except China. China sucked, but
you did get hit by China last year. That
was terrible. JP Morgan came out with earnings.
And how they do
transition on my part, but that's
right. That was not a smooth transition at all. That was a hard turn there. So do you want to talk about JP Morgan? Or do you want to spend like about 5 minutes on Twitter? What do you want to do? Your call. I don't care either or.
You know what? We probably have a little bit of time I think we have enough time to do both.
All right, go. You lead the way on JP Morgan. I'll lead the way on Twitter. Go ahead.
Okay. So as far as the earnings go, net income was down 42% year over year. They said primarily due to inflation, supply chain issues, and the war in Ukraine. The provision for credit losses was $1.5 billion, reflecting a net reserve build of $902 million, driven by increasing the probability of downside risk due to high inflation and the war in Ukraine. It's a lot of big words there. But basically, he's saying that you can mostly add, if the war in Ukraine would not had happened, there would be an additional $1.5 billion on their earnings.
Yeah, they're still positive, though. They're still making money.
They're still making money. That's good. That's a good thing.
I mean, it's
still the best bank around, other than Goldman Sachs, maybe being arguably, at least tied, or, you can argue between those two. But he says we are facing challenges at every turn, a pandemic, unprecedented government actions, a strong recovery after a sharp and deep global recession, a highly polarized US election, which that was 2020. So I'm not certain why that's still coming up, but mounting inflation, a war in Ukraine, and dramatic economic sanctions against Russia. While all this turmoil has had serious ramifications on our company, its effect on the world, with the extreme suffering of the Ukrainian people and the potential restructuring of the global order. Wow, way to throw the conspiracy theorists a bone there, Jamie Dimon. But he said all that is more important. What another thing was not too surprising to me that they had a loss in revenue year over year. People were still getting their stimulus checks and depositing those.
Yeah, but they were spending them right away. They weren't like letting the bank having them invest in them. Most of the people I talked to who got stimulus checks, right?
Yeah.
They just went ahead and spent them all, like gone. They was just spent money, and they had it for like 2 weeks and it was gone. Some people made it last like a month, but it was spent right away. Nobody invested that money. Hardly anybody. I don't want to say nobody. Hardly anybody invested that money.
To his perspective, so far, consumers and businesses so far are in good shape. He says economic growth will continue in the second and third quarters of this year, but after that, it's hard to predict. You've got two other very large countervailing factors, which you guys are all completely aware of. And he said one of these is inflation and quantitative easing. You've never seen that before at this level, and the storm clouds are on the horizon.
Hey, hold on.
It may not.
So I hate to argue with Jamie Dimon, but like, isn't the government peeling back its QE?
Yeah, that's what I think. That's what
slowing down their buy-in of it.
Yeah, I think that's what he meant.
Okay, all right.
Reversing.
And let me explain what that means to listeners who might be listening right now. So the government each month has been pumping in, I believe, $80 billion of buying U.S. bonds. So they've been keeping the bond interest rates low, forcing people to go into stocks so that the stock market can go up. And then they've also been buying mortgages. So it's been like $40 billion a month in mortgages that they've been buying. And that means like the banks really didn't have to do much of a credit background check on these mortgages because they could just buy them, put them together, and the U.S. government's going to buy it.
Yep.
So it was easy money for the banks. And it was, they knew that stocks would be going up so they can make money in their investments because of the QE. But now with the government pulling back and they're going to slowly taper that off all the way back down to zero is what they said. That's what the Fed Reserve said. That means now they can't just give loans out to everybody. And that means that they also have to now actually invest in stocks that actually are worthwhile, not just every stock's going to go up.
Yep. You took kind of stole all the word, not stole, but you took all the words that I would have said. So that was.
Oh, my bad. I cut you off and I said what you were going to say anyways.
No, you didn't. But you got the thoughts out of we had a mind melt, just like me and Warren Buffett.
Right. There you go. Or as what did Obama say? We had a Jedi mind meld. Just to angry any fans out there right now. Just going to make them anger. But no, yeah. So it's I like Jamie Dimon. I think JP Morgan has a future, especially with rates rising. They're going to make money. He always knows how to make a buck. So they're always going to make money.
You just have to watch the yield curve.
Yeah.
That's it.
I mean, everybody took a hit on Russia. Everybody did. But they all made money in oil. So, I mean, to offset some of their the Russia hit, but it didn't offset all of it.
Yeah.
So, I mean, we just expected that. Some people took a bigger hit than others. I believe was it Shell and BP took the biggest hits. Mm-hmm. I mean, but we expected that, and the BP might still be able to ink out a profit here. So,
what do you think about Elon and Twitter?
Oh man! All right. So I just want to touch on this because I know like people are gonna ask, and yes, I know we don't have a huge listener base, but we do have a listener base. And so I do want to touch on Twitter and Elon, guys, this week. Elon coming out, doing the bid offer there, and then Twitter coming back and playing hardball with him. I actually still put it at 50-50 whether or not Elon will buy Twitter. I know if he would like to, but I know with all the pushback, he's not a patient guy.
Yeah. So why didn't he join the board? Because he had the option, right?
They said he had the option, but then he declined. I think there was more things behind the curtain there that we weren't seeing that was going on, and he decided not to in that regard.
Okay.
And like I said, Elon's not a patient guy in moments like this. He wants to see some kind of he made that announcement to get a reaction.
Yeah.
And maybe it was not the reaction he wanted. Maybe it was. I'm not inside Elon's head, but I know he's a very smart, calculated guy, and he does his Twitter posts sometimes in order. I don't want to use the word manipulate, but I can't think of a better one to manipulate people into react in a certain way that he expects them to react based off that tweet.
A few years ago, I think it was 2019, he got upset over the New Scientific American. It's a magazine. He got upset over the way one of the articles portrayed him. So he threatened to buy him out, and he made his offer over Twitter.
Yeah.
And it wound up not working out. They adopted a poison pill and all that stuff too. But I just think it's funny how he, he'll just like, I don't like this. I'm going to buy it now. Here's, $10 billion. Right. In this case, for Twitter, it's 54.2. So $54.20, which is a reference to 420 again. And I like Elon Musk. He's brilliant. What he's done with SpaceX and Tesla has been, and Neuralink, which is often not talked about. That's exciting new technology. The guy's amazing, but he's often a sideshow circus. And, you don't know whether there's something there to be watching or not. So I'm not buying Twitter based on a buyout here, because you said it's 50-50. I actually am starting to think that it's not really going to happen, and that he may not have been really that serious about it.
Oh, I think he was serious. If they would have said yes to that first offer, he would have bought it and been done.
I think I don't think they were going to take it.
Yeah, and I don't think he knew I think he knew when he made the offer that they would at first say no.
Yeah, and
so that's why he felt safe making the offer.
Yeah,
he's like, I know they're going to say no, but let me just throw this out here so it can look like I tried to do this. You remember? I mean, guys, look, this guy. So he got his money by inventing and creating a lot of these technologies at PayPal and a lot of these other technologies at Tesla and SpaceX. You got to remember, he created these technologies. He's a very smart person. He's very highly intelligent. He knows how to do these things. So he is like a Tony Stark in that way, in that he's not just a CEO, a businessman, but he also is a scientist, in that he can actually do the calculations and do the coding and the software.
I feel like he never really knows his end game, which is honestly, it's part of his brilliance, because it makes it easier for him to do whatever he's trying to do and to negotiate. When you always got the other person at the other side of the table on their heels and not knowing what your next move is, then you're at an advantage. And he's always like that with his thought process. You never know what his end game is.
Oh yeah. So long story short, am I buying Twitter solely based off Elon Musk takeover? No, I'm not buying it for that. Now, do I think that Twitter's fundamentals, determine a buy right now? No, I don't.
There's no earnings still.
Yeah, so I mean,
for over a decade.
So I mean, based off those two things, my answer is no, I'm not buying.
Yeah, management has been terrible, other than Jack Dorsey, who was kind of the light there, but he no longer exists as the CEO of Twitter. So I mean, management of Twitter, you can't turn a profit with the amount of users that they have. And on the other end of it, look at what Facebook has done and how much profit they've made. I'm not buying it. I have to like management, and I have to see him turn a profit.
At some point you got to be profitable.
Especially this year, I'm not buying anything that doesn't have a profit this year.
Now,
been for 6 months.
Yeah, right. So that's all I got on Twitter. That's my final word on that. But I do want to end with some calls. My final thought of the day, guys, is based off all the downturn in the market. I'm buying Apple on the dips. I'm buying Intel on the dips. I'm buying NVIDIA on the dips. I am buying Tesla. It dropped below $1,000 a share. As long as it stays below $1,000 a share come Monday morning pre-market, I'll be looking probably to enter in a position there. There are certain companies I'm buying based off the downturn in the market last week, but it's all the same ones I've been mentioning time and time again, the ones that are trusted and true that I know are going up. That's my final thought, Brandon.
Yeah, me too. You've already gotten all my buys. I don't have any new ones for this week, so I'm still, the last buy that I had was FedEx. I'm still bullish on it as long as there's no recession. But even then, I'm still going to hold it for the long term because I think it's at a great value right now. And that's my final thought. So,
so we don't have much thought. Just one person talks and the other one's like ditto.
I'm telling you, this third shift stuff, man, it has killed half my brain. So
there you go, man.
Thank
there
you, James O'Shaughnessy, for filling in the gap today with your book.
Right?
Yeah.
I mean, I would love to sit there and chat about Elon Musk and all the problems he solved around the world, but that's for another day. Let me
just say this real quick. Here's a final thought. A lot of the books that you read in investing are very general. They a lot of them will say the same thing over and over and over again. And I kind of got in that rut where the books that I was reading, they were all good, but they were just all repeating what the other books that I had already read said already, So I was really looking for something that had a strategy spelled out. Okay, tell me what to do. Don't tell me what's not working in the market. Don't tell me that that value stocks over the long term outperform, because this is all stuff that's already been in other books, the last 10 books that I've read. So, give me something more technical to go by. Give me something more detail oriented. What works on Wall Street is that. And then Warren Buffett and the interpretation of financial statements. So what works on Wall Street and Warren Buffett and the interpretation of financial statements, if you're looking for something more detail oriented, something that gets into the red meat of it, those are the two books that I would recommend.
Nice. If you want us to come to your college or university, let us know. I want to say hi to Charles, new listener. I told him I would do a shout out. Hey, Charles. Charles, if you want us to come to your university, let us know. We'll be happy to come over, set up a booth, and talk about stocks and
university.
Yeah, right.
Charles.
Yeah, no, he's gonna get a kick out of that. But yeah, we'll be happy to, guys. And when I do the post on Instagram and you listen to the show and you see the post on Instagram, I want you to comment if you want Brandon and I to write a book. Please leave a comment, man. If we don't get any comments about Brandon and I writing a book, then we might just not write a book. So
oh man, that would be a travesty.
I know we want to write a book, because as you flip from Brandon's page to my page, you're just going to be confused. All right, guys. Well, as always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.